Greece doesn't belong to the Greeks anymore. Piece by piece, bit by bit, and home by home, Greece is being sold to the highest bidder. And they have no ties to the land, they just have enough money to drive the Greeks out of the homes they've lived in for generations. But that's the cost to pay in the way of recovering from the debt crisis that nearly ended Greece, right? In over a decade, the country has gone from a nation of proud homeowners to a playground for foreign investors, cash-rich speculators, and short-term rental empires. What should have been one of Europe's most inspiring economic comebacks after the devastating 2009 to 2018 debt crisis has instead morphed into a cautionary tale of how quick fixes and investor-friendly policies can strip people of their own land. How did this happen? Did you know that Greece was once on its way to becoming the first Eurozone member to face a forced exit? That's right. The 2009 to 2018 debt crisis caused turmoil, the sort you couldn't ever imagine. Through revised policies, dedication, and unwavering spirit, Greece had the opportunity to rewrite its history as one of the greatest comeback economics in recent history. But that didn't happen. Oh no. Instead, the government's short-term goals, greed, and lack of foresight cast a shadow on what should have been an epic win for the Greeks. Today, the Greeks don't own Greece anymore. Property became a cornerstone of Greece's rebound, with apartment prices rising to 8.9% in 2024 and a further 6.8% year-on-year in Q1 2025, according to the central bank. Growth has been especially strong in major cities. In early 2025, prices rose 5.5% in Athens and 10% in Thessalonica, underscoring how demand has concentrated in urban markets where locals already face tight supply. Take a look at this graph that shows the Athens Residential Property Index from 2015 to 2020, highlighting the rebound post-crisis. Rent soaring is a phenomenon not limited to Greece, and you'd think that despite the apartment prices rising, which isn't to be celebrated, in any case, at least the land was going towards Greeks themselves, right? No, and that's what we're here to discuss. You see, in 2013, in the midst of Greece's debt crisis, the nation launched a golden visa system. We're basically talking about obtaining residency or citizenship by way of investment programs. This visa is offered by various countries to attract foreign investment. In essence, it's a pathway to obtaining residency and potentially citizenship in a country by making a significant financial contribution, often through investments in real estate, businesses, or other approved avenues. The Golden Visa isn't limited to Greece. Currently, over 100 nations, including Australia, Portugal, and Malta, all offer citizenship by way of investment. However, in this case, Greece launched the program in the middle of a debt crisis, and the government wanted to sweeten the deal as much as possible to attract non-EU buyers. Still, what could have been an epic economic win has instead deepened inequality, locking many Greeks out of their own housing market. Foreign capital, enticed by lenient golden visa terms and high-return urban properties, has reshaped neighborhoods faster than wages can catch up. Data on prices and capital flows help explain why many Greeks feel priced out. Research tracking the 2017 to 2024 period finds cumulative house price growth of roughly 2/3 nationwide, with double-digit annual gains common since the late 2010s, well outpacing typical wage growth. Meanwhile, real estate soaks up an outsized share of foreign direct investment. In 2023 to 2024, property accounted for more than 43% of FDI, reflecting how international money has targeted Greek bricks and mortar as both a safe asset and a residency gateway. For locals, the combination of rising purchase prices, tighter rental supply, and investor-favored rules translates into higher barriers to entry and longer commutes to the few neighborhoods that remain affordable. Even with little tweaks here and there, the program remains unusually flexible. For example, there's no stay requirement, a 5-year renewable residency tied to the asset, and other measures that keep Greece competitive among EU residency by investment schemes and sustain foreign appetite for urban property. While recent policy tweaks aim to slow the tide, they may be too little too late. Tourism is a good thing, over-tourism is not. Short-term rentals became more popular as the debt crisis went on. Warehouses, basements, and former industrial zones were transformed and marketed as chic rentals, more aesthetic than functional. Residential areas have now been transformed into de facto tourist zones. For example, in central Athens, short-term rentals now outnumber hotel rooms, fueling both over-tourism and housing displacement. This proliferation has pushed locals further away from urban centers, as available long-term housing diminishes and rents climb. Prior to the 2008 financial crisis, Greece's housing market was characterized by high rates of home ownership. Around 74% of Greeks own their homes, well above the EU average. A study by the Athens Observatory of Housing Prices revealed that neighborhoods with high concentrations of Airbnb listings have seen long-term rental availability shrink by 46% to 58%, significantly increasing rents in those areas. This graph, sourced with data from the Bank of Greece, shows property price changes in select urban areas in Greece from 2016 through 2023. Greece has an outright banned Airbnb. By 2019, short-term rentals were generating approximately 1.4 billion euros annually, equivalent to roughly 0.74% of Greece's GDP. However, the government has been made increasingly aware of how short-term rentals have transformed urban areas into tourism hotspots, driving out the locals themselves. In early 2025, the government proposed a sweeping ban on the rental of renovated warehouses, underground spaces, and former industrial sites, ensuring that allowed properties must serve as primary residences, complete with natural light, ventilation, and air conditioning, rather than makeshift tourism accommodations. Simultaneously, authorities introduced a one-year moratorium on new short-term rental licenses in high tourism districts such as Kolonaki, Koukaki, and Exarchia in central Athens. Violators face fines up to 20,000 euros. These regulatory efforts are part of a broader strategy to balance the economic boon from tourism. Short-term rentals contributed about 13% of Greece's GDP in 2023, with protection of long-term housing affordability for locals. To further encourage this shift, the government is offering tax incentives aimed at landlords willing to convert or offer their properties as long-term rentals instead. Commercial gentrification. That'd be an appropriate term to use when discussing what's happening in Greece's rental market. In high-density rental areas, transient population syndrome has eroded community ties as locals are replaced by short-term visitors. Dimitris Karakostas of the Athens Resident Association notes it's not just homes lost, but the neighborhood baker, watchful elderly neighbor, and familiar faces that vanish. Historic districts like Plaka, Koukaki, and Exarchia now see up to 75% of flats turned into tourist units, creating ghost buildings. Local shops and taverns are replaced by souvenir shops and upscale eateries, a wave of commercial gentrification that strips cultural identity and inflates living costs for the few residents who remain. Greece's experience with short-term rentals reveals the fine line between tourism growth and community survival. By 2024, residential property prices in Greece were rising at a rate far exceeding the growth of disposable incomes. In effect, the people of Greece were being told they'd have to leave their homes, history, and heritage behind because foreign investors had more money than they could have ever dreamt of. What were they buying? Well, Greece, obviously. After suffering the longest recession in modern developed economic history, Greece endured steep GDP losses, soaring debt, and severe austerity. Many Greeks lost income and property, and public housing was neglected, setting the stage for a return to liberal, market-driven housing policies. Although Greece officially exited its bailout programs in 2018, the scars of the debt crisis continue to run deep. Years of austerity left public services underfunded, wages depressed, and housing policy heavily liberalized. Unemployment fell from its peak, but job quality lacked, with many working in low-paying, seasonal or gig economy roles that haven't kept pace with rising living costs. Greece's post-crisis recovery strategy relied heavily on attracting foreign capital rather than rebuilding domestic purchasing power. As the economy recovered, housing became more financialized. Global investors, vulture funds, and REIT-like structures entered the market, viewing Greek homes as investment vehicles rather than living spaces. Property prices surged. Overall housing prices rose more than 75% between 2015 and 2024, with price-to-income ratios making Greece one of the most unaffordable European markets relative to local earnings. By 2024, foreign buyers accounted for 80 to 85% of real estate transactions, collectively purchasing about 2.75 billion euros worth of property. Prices have since soared even further. In 2025, Athens' coastal areas saw 15 to 20% annual growth, and places like Piraeus experienced nearly 29% inflation. You cannot trace the cause to a single issue. What's happening in Greece today is the culmination of several missteps taken by the government over a period of decades. Many Greeks believed that not only could the debt crisis have been solved, but the government also lied about it. In October 2009, The newly elected Prime Minister George Papandreou's government revised Greece's projected budget deficit for the year from 6 to 8% of GDP, as claimed by the previous administration, to 12.7%. This figure was later updated by Eurostat to over 15%. The admission alarmed the European Commission, Eurostat, and global financial markets, exposing years of misreported statistics and heavy borrowing. Unsurprisingly, a 2015 Ipsos survey asked citizens across 9 EU countries to attribute blame for the Greek debt crisis, with results showing that 88% held the Greek government largely responsible. Debt led to borrowing, and borrowing came with austerity measures. If the Greeks believe there's anyone to blame after the Greek government itself, it's the European Union. The EU's austerity measures were harsh, more so the second time than the first, and almost guaranteed that there'd be a cost of living crisis in the country. Well, there was, and now people needed a way to make more money. The government needed more money. More importantly, they needed that money quickly. Short-term goals included the Golden Visa program, in which the minimum required investment for eligibility reached €800,000. The money was coming in, sure, but it came at an even greater cost. In urban areas, about 1 in 3 Greek households spent more than 40% of disposable income on housing, far exceeding the EU average of around 10%. As one affected resident living on the Athens Riviera put it, "I don't want to leave my home, but I also can't enjoy it. They say the value of our homes has increased, but when construction destroys your quality of life, what's the point? Can affordability for locals be reclaimed before the opportunity slips away forever?" Yes, the Greek government is actively working to mitigate the damage caused by short-term rentals. Yes, they've imposed stricter conditions on Airbnb rentals, incentivizing hotel stays over such platforms. Yes, the people and the government can actively agree that there is a problem. But acknowledging the problem is only step one. What comes next is actively solving it. Do you think Greece is too far gone? In the hands of foreign investors no less, and Greeks will never be able to reclaim it? Let's cover everything that has happened since the problem was first understood. Tax incentives, for starters. To encourage homeowners to shift properties from short-term tourist rentals, the government introduced a 3-year tax break, along with plans to raise taxes on short-term rentals and ban new licensing in central Athens, aimed at boosting available housing for residents. Also, in August 2023, reforms raised minimum property investment thresholds, ranging from €400,000 up to €800,000 in high-demand regions like Athens and the islands. While these incentives, coupled with some accountability, can be appreciated, we're missing the larger problem here. Houses won't become cheaper, and Greeks won't just become richer either. Wages in Greece have not kept pace with the soaring cost of property. According to Eurostat, median disposable household income in Greece is among the lowest in the EU, and even with modest annual increases, it would take decades for earnings to catch up to the current market prices, let alone the inflated values driven by foreign investment and speculative buying. Housing prices, on the other hand, have grown at double-digit rates in high-demand areas since the mid-2010s. The market is shaped by global capital flows, tourism revenue, and policies that until recently favored investment over local affordability. Even if the wages rise, foreign buyers will almost always outbid locals, especially in urban centers and coastal hotspots. Moreover, housing affordability isn't just about purchase prices. Renters face some of the highest rent-to-income ratios in Europe, with many spending over 40% of their income on housing. That leaves little room for saving towards a down payment, meaning that the dream of buying back homes is increasingly out of reach. Homeownership rates have declined from 77.2% in 2010 to 69.6% by 2023, while the rental segment expanded from 18.2% to 22.7%, though still mostly unregulated. According to an April 2025 policy study titled "Housing as an Investment in Greece and Southern Europe," Greece registers significantly low levels of mortgage ownership compared to other countries, highlighting a national tendency towards homeownership without mortgage financing. The financial crisis left many homeowners financially stranded, and properties that once stayed within families for generations have increasingly been sold off under pressure. In many cases, buyers were not other Greek households but investment funds, overseas speculators, or individuals using homes for short-term tourist rentals. If Greece is to reclaim its housing market, it will require more than tax incentives and investment thresholds. It will mean setting firm limits on speculative ownership, creating a meaningful stock of affordable housing, and ensuring that rental markets are fair and regulated. Without decisive intervention, the idea of home ownership for many Greeks will remain just that, an idea.